Hi, welcome to our webinar today, which is a tax overview on the recent changes. I'm Nicole Miller, I'm a legal director here, and I'm joined by my colleague B, who's one of the solicitors here in our private wealth and inheritance department. If you have any questions as we go along today, then please feel free to add them to the chat and we'll pick them up at the end. Otherwise, you're welcome to follow up with us after the webinar. So as I say, today is just an overview on the 2026 tax changes. We'll be looking at inheritance tax, capital gains tax, income tax, and some future changes that are affecting estate planning matters. We'll start off with a brief overview of these taxes, look at the recent changes and any sort of potential planning considerations that there might be available for individuals and families. In relation to inheritance tax is a tax that is paid on your estate on death, and in some cases during lifetime if you're setting up trusts and making what we call chargeable lifetime transfers. The inheritance tax threshold, known as the nil rate band, is £325,000, and that's been the case since 2009, and it's frozen at that value until 2031. This is limited by any lifetime gifts that you might make in the 7 years prior to your death, depending on the nature of those gifts. More recently, the government introduced the residence nil rate band in April 2017, which is currently at £175,000. And again, this is also frozen until April 2031. The residence nil rate band is only available when passing a main residence down to direct descendants, so to children and grandchildren. And if you've already sold your property prior to your death, then there is a downsizing provision for individuals who owned a property from July 2015. So the residence nil rate band has a few more criteria that need to be met in order for you to qualify for this, but it's something that can help a number of estates in terms of mitigating inheritance tax. As you may already be aware, there's a spouse exemption, which means that any transfers between spouses is free of inheritance tax regardless of the value. This assumes that both spouses are a long-term resident in the UK. There's also charity exemptions. If you choose to leave any assets to a charity in your will or on your death, then those assets passing to the charity will pass free of inheritance tax as well. Where you have benefited a spouse or there is any leftover nil rate band once the first spouse has passed away, there is what we call the transferable nil rate band, which allows the surviving spouse's estate to claim the unused nil rate band of the first spouse to die. And anything that is then above the nil rate bands that are available is then subject to tax at 40%. If you do leave more than 10% of your estate to charity, then that rate of tax drops from 40% down to 36%. That's sort of a brief overview of sort of the current inheritance tax position, but with the freezing of those thresholds until 2031, there is increasing exposure for many estates in this country who will end up paying inheritance tax. The latest forecast from the Office of Budget Responsibility estimated that inheritance tax revenues will amount to £8.7 billion in the 2025-26 tax year, which equates to approximately 0.7% of all forecasted tax receipts for the country. There's been a significant increase in the amount of inheritance tax that is being paid in this country since 2009-10, and that's mainly due to increases in asset prices. And when we think that property makes up a large portion of estates in this country and house prices have risen substantially over the last 20 years, it's quite easy to see how this increase has come about. Also, the fact that we've had the nil rate bands frozen since 2009 means that there's a lot more estates that are falling in to the inheritance tax net. This together means that we generally see a lot more clients wanting to review their estate planning, and it's really important that those estate plans are kept up to date and reviewed on a regular basis just to see whether there's any potential areas in which you could mitigate your inheritance tax liability. There's also some changes that have come to place very recently, earlier this month, in relation to business property relief and agricultural property relief, or business relief and agricultural relief as it's also known. So business property relief is usually available for trading businesses and on unquoted shares at up to 100%, and on land, buildings and machinery used in businesses that have been held for at least 2 years at up to 50%. The agricultural relief applies to qualifying property, which includes land, pasture, stud farms for breeding and rearing horses, and farmhouses and cottages that have been occupied for agricultural purposes. And the rate of relief for agricultural relief is again up to 100% if the owner has occupied the land for 2 years or more prior to their death, or if it's been owned for 7 years but occupied by someone else for the purpose of agriculture. There are other assets that qualify for relief at 50%, such as untenanted land. This webinar is not about the ins and outs of agricultural relief, so I won't go into any more detail there. But up until the 5th of April this year, the relief for business and agricultural relief was available at 100% or 50%, regardless of the value of the assets that were concerned. Since April this year, the level of relief has been now limited. Initially, the discussion was for the changes to limit the relief to 100% on the first £1 million of combined agricultural assets and business assets, with the balance of those assets then qualifying for relief at 50%. And this allowance wasn't transferable between spouses, which had a potential to have a large impact on a number of families. In the autumn budget last year, the government announced that the 100% relief would be transferable between spouses and civil partners, including those that had already been widowed. And at the end of last year, in December, the £1 million cap was lifted to a £2.5 million cap. So this means that the first £2.5 million of qualifying assets, whether business assets or agricultural assets, would qualify for relief at 100%, with the balance then qualifying for relief at 50%. Obviously, where the assets only qualify for relief at 50% anyway in relation to those business and agricultural assets, that 50% still stands. This only impacts the 100% relief. And this change effectively provides married couples with up to £5 million worth of inheritance tax allowances in relation to these qualifying assets. Despite this change, which has improved matters for families, this is still going to have a massive impact on families who 2 years ago would have benefited from up to 100% relief on all assets, regardless of those values. And as a result, these reforms are expected to result in over 1,000 more estates across the UK now paying more inheritance tax in the current tax year than they would have done previously. There's also something to be aware of in relation to those holding shares in companies on the AIM market. So these are people holding shares as passive investments, often purely for inheritance tax planning purposes, where they will now only qualify for 50% relief regardless of the value. So this impact has a large impact on a number of business owners, especially those with high value estates and assets. There's also some changes afoot in relation to pensions. So currently most defined pension contribution pensions are not subject to inheritance tax, and the lump sum that is attributable to that passes outside of the estate for tax planning and succession purposes. This has allowed many people over the years to use pensions as an efficient inheritance tax planning tool, but these inheritance tax advantages are now set to be removed from next April. So come April next year, the value of the pension pot is going to be included in the value of the total estate for inheritance tax purposes. And this could therefore mean that the pension is then subject to tax at 40%, depending on the rest of the estate and those no-weight bands and other allowances. This change to the pensions is in addition to the income tax charges which already apply to pensions, which means if the pension holder dies after they've reached the age of 75, the beneficiaries of those pensions will pay income tax on any withdrawals and lump sums at their own marginal rate. Although if they died before this age, the beneficiaries would pay no income tax, but the inheritance tax and income tax points will be working together, which means there could be a substantial loss to these assets as a result. It's useful to note that any pension funds passing to spouses or civil partners will remain exempt from inheritance tax due to the spouse exemption, but obviously the surviving spouse then needs to consider how they're going to use their estate and what steps they can take to try and mitigate inheritance tax in the event of their death. Further, any dependent pension schemes, which are typically provided through defined benefit or collective money purchase arrangements, will continue to be exempt from the new inheritance tax rules. So these pensions are often structured to support surviving spouses or financially dependent beneficiaries with ongoing lump sum income rather than providing them with lump sums. So there wouldn't be any inheritance tax changes there. Also worth noting that the agricultural relief and business reliefs will no longer apply to any funds held in pension schemes. So this means that pensions will be even less favourable vehicles than they were before for holding these assets. Despite the tax changes of pensions, life insurance lump sums and death in services are continued to be excluded from inheritance tax. So going forward, individuals are going to need to reconsider their estate planning, look at their retirement goals in order to try and minimise any potential inheritance tax that might be due. And it's important that they seek ongoing appropriate advice from both lawyers and financial advisors in order to try and mitigate any inheritance tax exposure, or potentially consider taking out life insurance to insure against any potential inheritance tax liability that might arise. Obviously, these pension changes, like I said, are set to come in from next April. There might still be some changes to how they're implemented, but at the moment, that's what the position is. So in summary, in relation to inheritance tax planning and considerations, it's really important that individuals review their current pension arrangements and their overall estate value, review and update any nomination forms that might be applicable in relation to those pensions, because the pensions, as I say, although will be subject to inheritance tax, will pass outside of the estate for succession purposes. So it's important to make sure that the balance of those pensions after the tax are passing to your intended beneficiaries. It could be worth considering making some lifetime gifts of non-pension assets to try and reduce the value of the estate. These gifts are generally known as potentially exempt transfers. This is because if you survive 7 years from the date of the gift, they would then fall out of the value of the estate for inheritance tax purposes. And no one knows when they're going to pass away, so no one knows when that 7-year clock is going to be important. But if you've got assets that you feel you don't need at the moment, it could be worth considering making some lifetime gifts. We all have an annual exemption in relation to lifetime gifts, which is £3,000 a year. And if you didn't use last year's annual exemption, last tax year, then you can claim that and use that in this year as well. So you could potentially give up to £6,000 this tax year and then £3,000 thereafter. Also, if you have any surplus net income, so if your income exceeds any of your outgoing needs, then there's an exemption in relation to making gifts out of that surplus net income. It's quite detailed in terms of the exemption itself, and we need to be clear that you have to have surplus net income that you don't need to draw on to maintain your normal standard of living. And this could fluctuate on a year-by-year basis depending on your outgoings and your income needs. But again, it's something that we can review with clients to see if we can help there. Some individuals also like to consider using trusts and some more detailed estate planning, such as family investment companies, to control the distribution of their assets going forward. It allows them to make transfers now out of their estates without necessarily passing it to the ultimate beneficiary at this time. So depending on the needs of that beneficiary, using a trust might be more appropriate than passing it straight down to, for example, an 18-year-old child. And with all matters, it's important that these are kept under review. So we always advise our clients to have a regular review of their wills and estate planning structures with us, with financial advisors as well, in terms of the estate planning matters. But every 3 to 5 years, you should certainly be reviewing your will, especially in light of these changes, to see whether there's anything further that should be done or needs to be done to mitigate any inheritance tax that might be due. Going to pass over to Bea now, who's going to look at some capital gains tax matters.
Thank you. Moving on to capital gains tax, or CGT. CGT applies when an individual disposes of an asset, so that could be selling, gifting, or otherwise transferring it. Importantly, it's charged on the gain, so the increase in value rather than the total proceeds. So, for example, if you bought an asset for £100,000 and sold it for £150,000, CGT would apply to the £50,000 gain. The rate of CGT depends on two main factors. Those are the type of the asset and the individual's income tax band, so whether they are a basic rate or a higher rate taxpayer. In terms of current rates for residential property, the rates are 18% or 24%, and for other assets such as shares or investments, the rates are 10% or 20%. So CGT is very much something that needs to be considered alongside a person's wider income position. Each individual benefits from an annual exempt amount, which is currently £3,000. This means you can make gains of up to that amount each tax year without paying CGT. This exemption cannot be carried forward, so if it's not used in a tax year, it's lost and it is available to per individual. Spouses or civil partners each have their own allowance. One key planning point is that Transfers between spouses are CGT free, meaning you can move assets between spouses without triggering a tax charge at that point. Another important concept is the CGT free uplift on death. This means that when someone dies, their assets are effectively revalued to their market value at the date of their death for CGT purposes, so any gain during their lifetime is wiped out. From a planning perspective, this gives rise to a few opportunities, so transferring assets between spouses before a sale, using 2 exemptions on disposal, and potentially spreading disposal across different tax years. In terms of how CGT applies in practice, when it comes to property and investments, the main residence is usually exempt under what's known as principal private residence relief. This relief means that if a property has been your main home, any gain on its sale is generally exempt from CGT. There are also some specific provisions. For example, if someone moves into a care home, the final 36 months of ownership may still qualify for relief, even if they are no longer living in the property. However, CGT will typically apply to second homes, buy-to-let properties, and investment portfolios, so assets that are not your main residence. A key practical point to flag is that UK residential property gains must be reported within 60 days, so there are relatively tight reporting requirements following a sale. In terms of planning opportunities, there are a few key points to keep in mind. Firstly, making use of the annual exemption each tax year can be very helpful in reducing overall CGT exposure. Secondly, the timing of disposals can make a real difference. For example, spreading disposal across tax years to make use of multiple exemptions. And as mentioned earlier, transfers between spouses prior to sale can also be beneficial, particularly where one spouse has unused allowances or is in a lower tax band. It's also important to consider the interaction with inheritance tax planning, as decisions made for CGT purposes can affect the overall estate position. And finally, in some cases, holding assets until death may eliminate CGT due to that uplift in base cost that we mentioned earlier. Finally, moving on to income tax. Income tax applies to income received during an individual's lifetime above the personal allowance, which is currently £12,570. This means that income up to that amount is generally tax-free. There are a couple of key allowances to be aware of. That's the personal savings allowance, which allows you to earn a certain amount of interest tax-free, either 500 or 1,000, depending on the tax band, and the dividend allowance, which allows a small amount of dividend income to be received tax-free. Income tax applies to a range of income, including employment income, rental income, for example, from buy-to-let properties, and dividend and investment income. And in terms of rates, we have the basic rate, which is 20%, the higher rate 40%, and the additional rate is 45%. A few key points to highlight when thinking about income tax in practice. Firstly, rental income is taxed at an individual's marginal rate, meaning it is added on top of other income and taxed at whatever rate applies to that individual. Secondly, the dividend allowance has been significantly reduced, which is something we're seeing impact many clients who hold investments. It's also worth noting that trust income is generally taxed at higher rates, which can affect how and when trust structures are used. There's also an interaction with personal allowances, particularly where higher levels of income can reduce or remove those allowances altogether. And finally, one simple planning point is to consider holding funds within an ISA, which is a tax-efficient wrapper where income and gains are generally generally free from income tax and CGT. And as always, we would recommend that clients seek advice from an accountant where appropriate. And I will hand back to Nicole, who will take you through the final points and our key takeaways.
So yeah, thank you for listening. So just in summary, inheritance tax exposure is increasing for all clients due to those frozen thresholds and increases in property values, which means that it's even more important than ever to undertake planning at the appropriate time. The changes to business relief, agriculture relief and pensions is also going to have a significant impact on a large number of our clients, and again needs detailed planning to try and mitigate any inheritance tax that might be due. Capital gains tax and income tax obviously remain key considerations throughout our lifetimes in terms of the income that we're receiving and when and how to dispose of any assets to try and mitigate any capital gains tax liabilities. And it's important to note that there isn't a one-size-fits-all approach. Planning has to be tailored on a case-by-case basis, and each of our clients have different needs and different requirements. We always work together with accountants and with financial advisors to ensure that our clients are getting the best and sort of most rounded advice in terms of any estate planning. In terms of the next steps, review your current estate plans, review what you've got in place at the moment, the value of your estate and what assets there are, and your will to try and ensure that your will is as tax efficient as possible. There are sort of very basic things that can be looked at in relation to your will, where just sort of changing an age contingency could have an impact on the tax liability that your estate might face. Consider your exposure to the inheritance tax at the moment. So what's the value of your estate? Is there any way that you can reduce that down in order to maximise the level of NIL 8 bands that might be available and mitigate the level of inheritance tax that you might need to pay? And take professional advice early. Planning is something that sort of we need to do throughout our lives rather than sort of just at the last minute, although there are certain things that can be done towards the end. But planning early allows you to have the structure in place, keep it under review, but to mitigate tax as you go along without needing to potentially risk having larger tax burdens as a result of sort of last minute plans and changes. That's all that we've got for today. But if there are any questions, then please do feel free to pop them in the chat. If not, here are our contact details. So if there's anything from today or any other tax or planning matters that you would like any assistance with, please do feel free to get in touch with either myself or B. We can look to review your wills, we can look at your current estates and whether there's any sort of immediate planning options that might be available to you. Or as I say, if you've got a financial advisor, we can work closely with them to structure your estates in the best way possible to mitigate any tax that might be due in the event of your death. Thank you for your time today.